Good morning. My name is Aditya Pattanaik. I am an investment advisor at Sprott. The following excerpts are from a discussion I recorded with Rick Rule on the 15th of December, 2022. As our last call for 2022, we focused this discussion on precious metals in light of the underperformance of this segment in a year when most were expecting a very different outcome for both the metals and the miners. In addition to reviewing the investment thesis here, we also highlight specific opportunities that exist in this group based on the price declines this year. The rules for contrarian investing discussed in this call are very applicable to all commodity segments. In resource investing, as Rick has said many times, you are either a contrarian or you will be a victim. Best wishes for the new year, and I hope you have a happy and restful holiday period. Rick, we've spent a lot of time on these calls emphasizing the idea of thinking about the macro, but really investing based on the micro at the company level. If I look back at 2022, it is very difficult to ignore the first order effect that the macro has had on the price of equities in various asset classes. If I look at gold and if I look at the gold miners as an example, we've seen 7 straight months of declining prices from April to October this year, mostly in the back of what the Fed was doing with interest rates. We seem to have become more entrenched in this post-GFC paradigm of Fed intervention and the Fed saving the world, which is also resulting in wild extremes of excess liquidity and excess tightening. Now, when you combine this with all of the socioeconomic and political factors at play across the globe today in terms of China, Russia, the debt levels, deglobalization, recessionary indicators, decarbonization aspirations, demographic trends. There are a lot of competing forces at play to think about for commodity investors at the macro level. And all of these can potentially have a first order effect on price volatility. So I'd like to start our discussion today with 2 questions. The first question is, how do you process all of these contrasting factors in your decision-making process, particularly in light of the significant effect that they do have on prices in the near term? Do you simply ignore the price volatility related to the macro and invest in companies where you see value, or do you make thematic adjustments based on the macro trends that we see today?
Those are big questions, as you suggested. With regards to the dichotomy between macro and micro, I would suggest that macro helps you decide what to do, but micro tells you how to do it. And I agree that there are so many forces out there that it can become confusing. I would caution listeners that nobody, myself included, is ever going to get it right. You just need to get it right enough that you maintain or hopefully increase your purchasing power. So when you talk, as an example, about all of the factors that impact the gold price, in my experience, nervousness about the maintenance of purchasing power of savings in conventional savings instruments is what is primarily responsible for moving the gold price. I would suggest to you that the recent weakness in the gold price is really a function of the fact that real interest rates became less negative, which is to say that the impact of the rate of inflation relative to the nominal interest rate has become a bit less in real terms and much less in perceived terms, which is to say the increase in the nominal interest rate at the same time as the apparent decrease in inflation has given many people a belief that the Fed has things under control. And I think that's something that they want to believe. I don't happen to believe it, but that's a different circumstance. I will say that I myself am positively impressed with the incredible strength in the U.S. economy relative to what I would have expected to occur in the consequences of higher costs for capital and lower lower capitalized value of income streams as a consequence of higher interest rates. I am amazed that the U.S. economy hasn't been more impacted, as an example, by a greater than 100% increase in the 30-year mortgage rate, strong increases in the cost of capital for consumer durables and investments. And I'm impressed, too, that both the debt markets and the equity markets have held up in the face of lower valuations for capitalized income streams than they have. We discussed in earlier discussions, Aditya, the fact that the impact of interest rate rises often lag, which is to say that we may not have seen the worst of the impacts, as an example of higher cost of capital for borrowers. In fact, that may be in front of us. But I am frankly delighted with the response in the U.S. economy to what I had considered to be absolutely grievous blows. And I would point out, too, that investor confidence, which is oddly negative for gold, which is to say periods of high confidence are periods where people feel less inclined to need gold. The confidence that the market feels, I think, is partially a function of confusing liquidity. This market is extremely liquid. There are trillions of dollars on the sideline. With solvency, the fact that we owe more money than we can pay back, and our current method of outliving our living standards is something that simply arithmetically can't be contained. In the near and intermediate term, confidence is more important than reality. Confidence continues fairly high. We've had 40 years of benign economic climate. We have had an economy which has withstood higher interest rates better than at least I myself would have believed that we could. And two, we have seen capital markets that have reflected greater strength than I would have imagined, both in terms of higher cost of capital and lower valuations on income, on the capitalization of income streams. I would point out to you, however, Aditya, that we've spent 40 years learning that we don't need gold. And inflation has reared its ugly head for only two. I would point out further that precious metals market share relative to other forms of savings and investment is very small, less than 0.5%. You don't need very much disintermediation from an asset class like U.S. Treasuries into gold to have an outsized move in gold. It hasn't happened yet. Will it happen? One never knows. But I think the arithmetic argues in favor of it happening. And I would remind you again that a very small shift in terms of percentages can have an outsized impact in terms of return. And society as a whole is almost insanely underinvested in the space. I expect, although I do not know, that a rebalance will occur, a rebalance based less on narrative than on arithmetic, the way all great rebalances begin.
There were a couple of things you said in there that I think are worth following up on. The first one is nominal rates. When we've been talking about this, about the gold thesis over the last couple of years, it was always that interest rates are close to zero and real rates are negative. Now interest rates are close to 4%, and Jerome Powell today said that they're going to move it up to 5% next year. So they don't seem to have any concerns about raising rates on the one hand. And your second point was that the economy, in a broad sense, continues to be very resilient in the face of this historic rate increase. So the discussions we were having about gold a year ago, or even 6 months ago, are very different if we look at nominal rates today, even though if you bring inflation into the picture, we're still 2% negative. But given nominal rates, does that affect your point about disintermediation in any way?
It might. I think there are three things that one must consider when answering your question. The first is simply perception. we've spent 40 years believing that the big thinkers can take care of us. And most people would prefer to consign responsibility for their financial future to the big thinkers rather than taking it themselves. Most people want to believe that Biden is right, or Trump was right, or Volcker was right, or Powell is right. I personally do not subscribe to that school of thought. The second is that it is often the case that policy prescriptions take a while, that there is in fact a lag. The third thing that we need to take into account, however, is that there is a possibility that the underlying economy in the United States is so strong that we can forestall the question. It's important to note that during the period where we had nominal interest rates that were very low, we had reported inflation, which was also very low. And what matters is the delta between the nominal rate and the real rate. So if we have a circumstance today where the nominal rate is 4 or 4.5 and it's going to 5, if we see inflation at the 8.9% or the 7.9%, whatever it is, if we have the deterioration in the purchasing power of savings continue at 300 basis points, eventually that takes its toll. Where it takes its toll first is in the capitalized value of the long bond. And the deterioration in credit quality and solvency among the very large institutional investors, the pension and profit sharing plans that keep a substantial amount of their corpus, of their portfolio in very long bonds. The deterioration that you see in bond capitalization in a period of rising interest rates, but particularly in a period where the interest rate doesn't keep pace with inflation, becomes really problematic for the very large institutional investor. And that is where you would expect to see disintermediation occur first. I don't think that we've seen it occur to any substantial extent, except in Great Britain, of course, where the interest rate was allowed to go up and where the institutions, oddly, were using short-term credit to buy long-term obligations. So at the same time that the capitalized value of those distributions declined, their cost of carry increased. And we had a circumstance where the British government had to change feet very quickly for fear of blowing up every pension fund in Great Britain. I think that we have to have a realization in the United States that some of the largest institutional pension and profit sharing investors in the United States, and of course the US Fed, are carrying very substantial unrealized losses in their long bond portfolios. And to the extent that even nominal interest rates continue to go up, those losses will increase. What's much more problematic is the ability of those institutions to service their obligations 10 years, 15 and 20 years out to retirees when the nominal value of the income they receive is much less than the deterioration of the purchasing power of the corpus of their assets. And that is really the crux of the case, in my point of view, for gold.
We've talked about timeframes many times on these calls, and the reason for it is because I interact with clients, and a lot of the times the questions are, they're looking at things over 6 months or 1 year or 2 years, and how do you quantify when? If it's an unquantifiable variable, are you willing to sit there for 5 years? When do you decide that it's time for you to change your thesis?
I think you need to juxtapose that question, which is a good one, with how do you value if? How do you value the probability that the US 30-year Treasury, which is a widely held asset, doesn't cost you 60 or 70% of its nominal purchasing power over its life? how do you, in juxtaposition to your thoughts about gold, justifying the U.S. 10-year Treasury, which, based on current arithmetic, almost guarantees the destruction of 50% of your purchasing power? I understand, Aditya, that you would like some certainty in the positive side of the question, but I think you need to juxtapose the probability on the positive side of the equation with the probabilities on the negative side of the equation. And I think you need to say, in the context of your portfolio, that there is a higher probability of a positive outcome, irrespective of time, asking yourself a when question than an if question, or more importantly, a never question, like the U.S. 10-year Treasury.
Yeah, I guess the big question here, when I think about monetary and debt cycles and timeframes over which they play out, they may exceed most people's investment time horizons. And I think that's something that everybody needs to think about.
And I don't think that is something that you can lay to gold. I think you lay that to human frailty. People believe that their time frames are relevant. Warren Buffett has famously said that one of the things that the market is a very efficient mechanism for transferring wealth from the impatient to the patient. Now, most investors wish that wasn't true. And I think after 40 years of benign economic climate, most investors actually believe that their wishes have some validity. The truth is that the market doesn't care about your wishes. The Fed doesn't care about your wishes. Gold doesn't care about your wishes. What matters is what is probable, what is the outcome, how much risk you can afford, and what timeframes are reasonable as opposed to preferable. The fault here isn't with the market, it's with the investor.
I think a lot of people that I have gotten involved with over the last couple of years have started this process of being actively engaged with their investments in a very high liquidity environment where things were moving up very quickly and things were moving up a lot, disconnected from valuation. Recently, you had actually put up a post on LinkedIn about liquidity driving things. Have the nature of the markets changed for you, or was that a temporary aberration over the last couple of years?
I think people's reaction has changed. I think that confusing liquidity for solvency, which is what most people are doing, is a trap. I think that there is a benign sense of the market that is really a function of liquidity that sets people up to have their legs cut out from under them by a lack of solvency. I think, too, that 40 years of benign economic climate have caused most investors to favor speculation and trading over investing and value. Now, make no mistake, Aditya, all the money that I now invest prudently, I made by speculating wildly. And I'm not suggesting that people who can afford financially and psychologically to speculate shouldn't do it. I absolutely encourage speculation. But I don't think that investors should confuse the two. I think that people need to invest before they speculate, and they need to speculate with an investment mindset. People who are paying attention to the momentum that's driven by liquidity, people who are paying attention to narratives that have been in the near term proven as a consequence of price action, need to understand that the very price action that caused them to believe the narrative has taken away most of the benefit associated with the narrative. I found in the uranium markets earlier in my career, at the point in time where the uranium market was attractive, the price had to go up. The narrative was in place, but the price had to go up, and nobody cared. There were 5 uranium juniors. After the price moved from $8 a pound to $145 a pound, that move in the price had validated the narrative, and there was more interest in the uranium market above $100 a pound than there had been at $8 a pound, which is to say, because the narrative was validated by the price, more people were interested in the narrative when it had no value. Ironically, too, the number of issuers in the market went from 5 to 500 in that same period of time. That's particularly interesting because there were probably 15 competent management teams that existed at that point in time. In the beginning of the exercise, you could divide the number of issuers, 5, by the number of management teams, 15, and be relatively assured that your issuer would be run by a competent management team. After the sector became popular, the number of issuers, 500, could be divided, the number of management teams, 15, could be divided by the number of issuers, 500, and it was very unlikely statistically that your issuer was run by a competent management team. But the price action in uranium had justified for many people the narrative. People came to believe in the narrative at precisely the period where it was no longer relevant. And I suspect that that will happen in precious metals again. The interest in precious metals in the 1960s, when the price hadn't moved since the Roosevelt era and was in fact controlled by dictate, was non-existent, even though as a consequence of US policy from sort of 1957 and on, but particularly in the 60s, when President Johnson said that government could make citizens' lives better, that we could afford both guns and butter. In other words, even while the facts were arguing for a higher gold price, nobody cared about gold because the price hadn't moved. Indeed, in the decade of the 1970s, in the period 1970 to 1975, the gold price moved in reaction to a decontrol and inflation from $35 an ounce to $100 an ounce. In 1975, eerily reminiscent of today, when the Fed raised the interest rate, the gold price fell by half, although the government did nothing with regards to controlling the very government spending that had caused the crowding out in the interest rate market. When the increase in the interest rate began to slow down, the nerve of the Fed, and the Fed gave up its period of higher interest rates, the gold price again rose from $100 an ounce to $850 an ounce. What interests me is the fact that gold had more interest at $200 than it had at $35. And all those great friends of gold lost interest in it as it became more affordable. That is to say, as the price went down. I think we're in that same circumstance again today, Aditya. I think that gold, and in particular, silver, will gain adherence really as a consequence of a very small disintermediation out of long bonds into gold. When will this occur? I don't know. But my suspicion is that gold will attract many more adherents at $3,000 an ounce than it has at $1,700 an ounce, despite the fact that perhaps the best part of the move will already have occurred. Similarly, I know from past experience that people are much more interested in $50 silver than they are at $20 silver, to my benefit, to their detriment.
I'd like to switch this discussion to focus on opportunities in the market today. And I'd like to focus the opportunity segment of this discussion on two categories that you've discussed in some depth in your classroom series over the last few months. The first theme that I'd like to discuss is the mid-tier producers. I've heard you say this a few times now over the course of this year, that on a net present value basis relative to spot, this is the cheapest that you've seen this group in your career. And that is a pretty big statement. Now, I'd like you to talk about why you think that these stocks are being discounted at higher rates, while the cash flows from the gold miners are being discounted at significantly higher rates than the rest of the market, and whether if it's related to competence, or rather the lack of competence. Do you see this trend changing from an investor perspective if we get higher gold prices going forward?
That's a great question. I do believe that the producing miners are, by my valuation metric, which is to say net present value of future cash flow from reserves and resources, using pricing assumptions that are contained at spot in the forward strip, juxtaposing the enterprise value, which I would define as market capitalization plus cash minus debt. The juxtaposition between net present value and enterprise value is the cheapest that I have seen them in my career. Professional investors in the mining business were mightily abused in the decade 2000 to 2010, where despite a historic gold price escalation, the free cash flow per share of gold producers declined, which is to say that this was one of the most historically mismanaged industries on the face of the earth. What you're seeing now is institutional investors who are insisting that the companies return capital to investors, which is to say decapitalize, in favor of investing. You are seeing less M&A, although M&A, I believe, is inevitable. And you're seeing a suboptimal level of investment too, not to the degree that you're seeing it in the oil and gas business, but you're still seeing it. I believe that you are also seeing a differentiation in the market between companies that are believed to be well run. I'm talking about companies like Franco-Nevada, Wheaton Precious, and Agnico Eagle, and the rest of the market, where there is some question as to the competency of the management team. I think that the conservatism that you're seeing will go some way to dispelling the lack of trust that the investment community has in the gold community. I think, too, because it's been a very long time since we had a legitimate gold bull market, I would suggest that you either look back to the year 2000, 20 years ago, which is an eternity for many investors, or more accurately, back to the decade of the 1970s, and say that the market is nowhere near as conditioned to a gold bull market than they are to the renewal of a technology bull market or even a bond bull market, which I believe is really, truly unlikely. So I think that the expectation, the psychological environment that gold exists in is as challenging as the reputation of the industry for untrustworthiness is. I think that those are the two most important things. The third thing that I would point out is simply the extraordinarily small nature of precious metals and precious metals mining stocks as an asset class. When you have an asset class that is less than 0.5% of total savings and investment assets in the world, the fact that nobody pays much attention to it other than its adherence is entirely understandable. That's a self-correcting phenomenon. I remember back in the decade of the 70s when nobody talked about anything but gold. It was weird to see a circumstance in 1981 where it is believed that precious metals and precious metals related assets comprised in excess of 7% of U.S. savings and investment assets, which is to say when its market share was very great, and the gold price had already run from $35 an ounce to $500 an ounce. Interest in the metal was at a fever pitch. When, as a consequence of investor apathy, the selling price of gold and gold equities interests no one at all. This has been a common theme in this talk, but I think it's one that bears repeating again and again and again, because I think the malaise is partly a function of the malaise. It's certainly not a function of arithmetic.
Okay. I want to dig a little deeper into this point of things being statistically cheap, at least. A lot of analysts at banks in the reports that we receive contain an EV over EBITDA column.
Yeah.
And on that basis, again, a lot of these gold miners look very cheap on a relative basis compared to everything else. Now, Buffett has often pointed out that the flaw with EBITDA is that it doesn't give you any sense of capex. And we are in a very capital intensive business here. So while the sector from an earnings power perspective looks very cheap, if you look at it from an EBITDA perspective, when I do that same EV over free cash flow ratio, I get a very different picture for the sector. From a health perspective, you've talked about PNAV, but what about using earnings?
I don't think you can use earnings for the simple reason that gold mining companies are in perpetual decline. If you have a 10-year reserve life, the terminal value of your asset is zero. Aditya, if you and I owned a bakery and the inputs were bran, salt, sugar, butter, flour, and milk, we would likely be producing bread as efficiently 10 years from today as we were today with minor sustaining capital investments. If we had a 1 million ounce gold deposit that we were mining at 100,000 ounces a year, at the end of 10 years, we would have nothing. So EBIT, which occurs over the life of the mine, is illusory because you have no terminal value whatsoever. In other businesses, you may have a terminal value. Buffett's other point about the fact that EBIT is useful if you don't have any depletion or depreciation is useful too. But the most important thing with regards to resource companies, or at least extractive companies, is that the concept of recycle ratio, which is to say the concept of reinvesting free cash flows to maintain production and free cash flow over time, is the most important metric. So net present value, the net present value of free cash flow, not the annualized earnings or the annualized free cash flow, is what's important. The valuation metric in extractive industries is somewhat more sophisticated. You have to look at the net present value of cash flows and free cash flows, and then you have to look both at the pipeline of development projects that the company has, but also at the track record that current management has with regards to efficiently utilizing free cash flow to maintain free cash flow. In the oil and gas business, that's called the recycle ratio. Given the margin that you enjoy off a barrel of oil, can you replace or more than replace that barrel that you produced with new barrels that you have discovered and developed? The same thing holds true in the precious metals mining business. You have some companies like Randgold, part of the predecessor to Barrick, or Endeavor or Agnico, that have very, very good reputations for recycle ratio, which is to say they've done a wonderful job employing the margin that they've enjoyed from current production in maintaining and increasing the production, and hence increasing free cash flows in the future after depletion and depreciation.
Okay. This is an interesting discussion that I was having with one of my clients. The discussion was about good businesses and investing simply in good businesses. So that Endeavor Mining would come to mind, more so than Equinox Gold, based on costs. The flip side of this argument, from a stock perspective in the commodities space, is that the higher cost producers from a share price perspective tend to outperform the lower cost producers in a rising price environment. What are your thoughts on investing in high ASIC companies which have more leverage to the price of the metal, but potentially have more growth from a share perspective?
I think, and by the way, that's a lovely question. I think what you've done is you set me up to discuss the difference between investing and speculation. In the case of Endeavor, you have a group with a spectacular recycle ratio, a willingness and an expertise to operate in high-risk countries, which is to say a definable competitive advantage, a track record for high return on capital employed, and a reputation for being generous enough to share some of that return on capital employed with the owners, the shareholders. In Equinox, you have a very different value proposition. You have a management team, in particular, the non-exec chairman, Ross Beatty, who has a reputation for being able to build companies by acquisition, add cash back to cash-starved assets, wring more out of them, selling the third-tier assets and using the proceeds to buy first-tier assets and building companies. And you also have the optionality associated with buying a property, a big property that's marginal at current precious metals prices, but enjoys spectacular margins at higher precious metals prices. So you are at once speculating in a process led by a person, which is to say Ross Beatty, in acquire and exploit, at the same time as you are banking on proximal commodity price increases, which is to say you're engaged in a two-factor speculation. You are speculating on possibilities, whereas in Endeavor, you are investing in probabilities. It is very true in a rising gold price environment, particularly in a rising gold price environment where the narrative becomes positive as to gold, that the share price performance in an optimal situation will be much greater with the speculation than it would be with the investment. The question becomes, however, for each individual portfolio, is reducing the downside a reasonable trade-off for reducing the upside if you increase the certainty first. And secondly, when you look at the extraordinary volatility of the gold sector over time, and you understand that beta, which is to say the outperformance of the gold sector relative to the broad market during gold bull markets can be 300 or 400%, is achieving a 200 or 300% gain in a higher quality company acceptable relative to accepting much greater risk to principal in hopes of a 500 or 600 or 700% gain? Those are questions that the individual investor must ask himself or herself.
Okay, so that leads us well into my next question. And this is a question I got from a client recently, so I'm going to pose the same question to you. The question was, in a rising gold price environment, do you want to be in producers, developers, or explorers?
It depends on your tolerance for risk and your tolerance for volatility. It depends on, you remember that chart we used to use, Aditya, which you can send to the people listening to this interview if you want. It depends on the level of greed that you have relative to the level of risk that you're willing to endure. What you see in gold bull markets is that the beta in the market, which is to say the amount of performance in the market relative to other asset classes, is extraordinary. It is true that the returns to alpha are higher, as are the risks. I have asked people, or I did ask people for years when I was a broker, to imagine the market as a yardstick. And the one end of the yardstick, the 1-inch marker, is low risk, low reward. The high end at 36 inches is high risk, high reward. Now, what every investor wants to do is bend the stick so that he or she enjoys high return for low risk. If you do that, of course, the stick breaks. And so investors need to look where on this 36-inch continuum called a yardstick, this juxtaposition of risk to reward, they want to live. It's less important to think about how the market as a whole might react, and more important, you would like to see yourself in that market.
The question was specifically about leverage as well. So where I struggle with recommending explorers from a leverage point of view is that a lot of the times they don't really have anything. I guess it's a rising tide, a bet on a rising tide there.
Sure. Oh, well, the other thing that an exploration company can do occasionally is deliver, which is to say there is no activity in mining which can deliver as much value shortly as a drill hole. It is possible with one drill hole to unlock $1 billion worth of value. It happens very, very, very rarely. So people who are attempting to speculate in exploration need to understand that they are speculating less with regards to the commodity price than they are the outcome with regards to answering unanswered questions. I mean, for years, Aditya, people have asked me, Rick, what would be the impact of a gold price increase on the value of amalgamated moose pasture? And I need to say, sadly, amalgamated moose pasture has no gold. They're only looking for gold. And if the price of something that you have none of goes up, it shouldn't have any intrinsic impact on the value of your company. It may have an impact on the way that the market values the probability of your continued success, which is to say, if you're a good promoter, you may be able to promote on narrative, even though that narrative is actually irrelevant to your value proposition.
Yeah, it is strange how prices change for explorers. I mean, we've seen this for the uranium space, and this is where a lot of new uranium speculators participate in the uranium thesis is through the explorers rather than through Kazatomprom and Cameco.
How true.
And to some extent, the share prices when things were going up, the share prices for that group did perform. And so it did confirm, the narrative of the thesis. But if you look at underlying value, it disputes a rise in price apart from just the rising tide driving things.
And Aditya, the narrative-oriented speculators, perhaps in particular the newbies, who are attracted to stocks retroactively, based on the pricing of the narrative, in my experience, that theater of investors forgets to sell. So they believe that they're acting prudently. They believe that they're acting conservatively. They believe that they're acting on a narrative once the narrative has been proven by price. But then they forget to sell. If you are a momentum investor, that's one thing, if you're a speculator. But you have to remember to sell. You pay much less attention to fundamentals, to valuation in that circumstance. You pay much more attention to market technicals. I'm not that kind of investor. I want a direct relationship, a causal relationship, even though the relationship might not be immediate, between predictability, price, and value, personally.
I'd like to ask you the same question for the silver market. From a leverage point of view, particularly given the very small size of the silver market, how would you position a portfolio for leverage to rising silver prices between the different segments available in the equities group?
I love silver explorers when I have the third dimension, which is to say Silvercrest 2 years ago. The price was going down, although the drill holes were getting better and better and better. I love that circumstance. It's rare. In my experience in bull markets, the bull markets move like a circus master's whip, which is to say the larger, more successful companies move first, but the smaller companies, which move last, move furthest. And it's interesting how an investor might choose to be on that continuum. I have found again, as I age, that you can take away some of my upside if I capture the beta by limiting my downside. I have found too, however, Aditya, that optionality, that is leverage to higher prices, higher metals prices, works better in silver than it does in gold, because the price movements in silver are exaggerated And the narrative is more exaggerated still, because the market capitalization of the sector is so small that when general market participants try to crowd into silver, there isn't enough market cap to accommodate them. And the move in the sector goes way further down, the quality trail, than it does in gold and other sectors. So there is much more of an argument for speculating on optionality in silver than there is in gold, as a simple consequence of the structure of the market and the manic depressive nature of the silver bug.
Fair enough. Final question, Rick. Advice to investors looking forward into the year ahead. I mean, we've got all these flashing indicators of a recession, but we always seem to have that at the start of every year now. So how, given where we are today, given all of the things we've discussed, do you have any broad advice for our clients?
I absolutely do. First of all, visit with your broker. Call aditya, because preparing your mind for volatility and preparing your mind for risk, volatility and risk, by the way, are different things, makes you more able to take advantage of a circumstance than being taken advantage of by a circumstance. The second is to maintain liquidity. I realize that holding cash with interest rates much lower than the underlying rate of inflation diminishes your purchasing power. But regard the diminished purchasing power as an option payment for having the ability to take advantage of other people's illiquidity, should it come to that. Liquidity, or at least some of your liquidity, can be in gold. Some of my liquidity is in gold, because I'm mature enough that I will sell that gold and use it to buy another asset class, if another asset class in a very illiquid environment comes to me to be more attractive than my gold holdings. But perversely, despite negative real interest rates, you need to maintain liquidity, both because of the volatility that you will endure and also because of the real risk of recession and the related risk of illiquidity in debt and equity markets that might accompany recession. Ask yourself the question, where on the continuum between risk and reward would you like to sit? Do you see yourself investing in probabilities? Do you see yourself attempting to capture market beta? Or are you willing psychologically and financially to take the risk to be a speculator? If the answer is both, then assign yourself relative buckets that you think will conform with your ability to manage your reaction to risk. Finally, remember, and always remember, in natural resources, if you are not a contrarian, if you're not willing to be forward-thinking, if you're not willing to buy in anticipation of the value of the narrative, you will be a victim. That's a guarantee. If you're not a contrarian, you will be a victim. If you don't accommodate yourself to that fact, you need to consider some other form of investing.
Great. I think that's a perfect way to end it. Right now, I feel like I'm both a contrarian and a victim.